guess I'm just more like, they just give us something.
Happy Friday, everyone. We've made some improvements in one direction. Jerry's back with us. So as per our agreement from the last class period, Jared will be answering all the questions for today's class session. So yeah. We didn't actually make that agreement. I completely made that up. But Ben and Joe are gone because they're sitting for FAR. So apparently this is just a one of those revolving doors where students move in and move out, throughout the entire semester. So yeah, we'll look forward to that in the future as well. I guess when the baseball season kicks up is the Friday games. So yeah. Mm-hmm. All right, so it's like I've seen this before in the past. Yeah, today we are picking up audit testing and internal control, and we're gonna get a little bit in depth in that. I want to remind you all that we do have our first CPA assignment, a CPA review assignment next Friday. Questions for week 2 have already been posted. I'm going to post week 3 a little bit later today. So I'm doing pretty good and making sure I keep up with that. Obviously, you're welcome to work ahead, but it's not going to be too far ahead because I'm restructuring everything. As far as the questions, I want to remind everybody that what my expectation is, it's just like the multiple choice questions back from 417. In addition to answering the questions, I would like for you to provide me a brief explanation as the reason for your answers. Again, I accept and acknowledge the fact that it is a tedious chore to go through. I do think that it will benefit you in the long run to get to that habit of thinking about the questions in that way. I'm also going to have a few extra questions that we will work on in class, but I will be responsible for getting those coordinated. So those are going to be a surprise. So it will relate to the things that we're going to be discussing in that context. Also, as a reminder for the CPA review questions, it is going to cover everything that we could possibly cover in auditing, even some things that we aren't going to necessarily go into depth. You do not need to be afraid of doing some research on this if you're just completely, totally confused about what the question is asking. I expect that to happen. Again, the goal here is not to make sure you know about everything about auditing. The cram session will come when you start sitting and preparing for auditing, and that will be when the content comes in. This is more about learning how to answer the questions, how to approach the questions from the best perspective. So if you encounter a question, you say, I don't know what's going on, that's going to happen at least once. At least I expect it to happen at least once. If you in the situation where it's like, oh, I know everything, then, well, you're actually stronger than me. You need to be teaching the class. So yeah, I still, after this can be 10th year teaching auditing, I still encounter questions. I was like, I'm not really sure how to approach it, but that's going to be pretty natural. All right, let's go ahead and get into talking about the concepts regarding audit testing and internal control. We're going to start out with my favorite thing to talk about back in 417, management assertions. All right, so remember, these are commonly referred to as audit assertions or just blank assertions. If I use the term assertions in this course, that's what I'm referring to. So let's just go ahead and let's work out this in an intelligent sequence. Let's think about what are the big 3 assertions that you remember from 417. 2 of them were basically opposites of one another. What were those called? Correctness and enthusiasm and no, not absolutely. You were about to say something, Jared. I heard your mouth move, and it's like I'm not even specifically referring to telling you. What were you saying? Completeness?
Yeah, was it complete?
Completeness, yes. Completeness. What was the opposite of completeness? Anybody remember?
Existence.
Existence occurrence. Yes, very good. Completeness and existence occurrence. So why do I say that these are opposites? And the reason is because these are concerned with different aspects of information. Completeness is our recording assertion, or more specifically, did something get recorded? Now, I do want to make a clarification for this for those of you who don't necessarily remember all of these, which is fine. When we say completeness, it's basically, did it get recorded? Full stop. All right. Not did it get recorded properly? We do have multiple recording assertions that are going to relate to whether something was recorded properly, but this one is just saying, did it get recorded? If the answer is no, then it's a completeness violation. All right. Existence, on the other hand, is saying something has been recorded. Do we have evidence of its existence? All right. Now, the reason that these are opposite assertions is because they move in different directions. When we talk about completeness, we're going to start with the source documents and move to the records, okay? Because we know that the transaction exists or the underlying items exist, but we need to make sure did it go into the system to get it recorded. So we think of this as being going from the bottom, which is basically the foundation stuff, to the top, which is the records. We think about existence occurrence, the opposite thing. We know it's in the system, Can we find the foundation? Can we find the source of the information? So we stop from the top and go to the bottom. All right. Now, there was an easy way to remember this, which we're going to talk about when we get into the evidence. But remember, the directional assertions have tests that are associated with them. So we'll get into that in just a little bit. But for right now, remember, completeness, bottom to top, existence, top to bottom. All right. So the direction that they move is really, really important. So this is two of our big three assertions. The third, and the reason I call these the big three assertions is these are going to be the assertions used about 70 to 80% of the time in audit. And they're going to be very, very, very important. What was the third of these? And I will give you a hint. It is a recording assertion, but it's more about recording properly rather than something that recorded. Does anybody remember? 3 letters. VAA, valuation, allocation, and accuracy. So did this get recorded at the proper amount? Right? Trying to make sure that items get recorded at the proper amount. So if you forget everything else about management assertions, and don't forget everything else about management assertions, because I'll be really disappointed if you took my class and forgot that. But if you forget everything else sitting for the CPA exam, remember these 3. Know these 3, love these 3, make sure you know everything about these 3. Because even though you will likely run into questions that are going to relate to other assertions, these 3, I will guarantee you will be on the CPA exam to some capacity. In fact, they will be in multiple capacities. And so if you just say, I'm only going to learn these 3 assertions, you're probably good for about 75%, which, let's be honest, 75, that's the golden, that's the standard right there. So, all right, but let's just make sure that we're thorough in our analysis. So let's go ahead and talk about some other assertions. Now, one of these assertions relates to account balances only. It has to do with whether or not we have the right to recognize assets on the balance sheet, or we have the obligation to recognize liabilities. Does anybody know what assertion I'm talking about? The rights to recognize assets and the obligation to recognize liabilities. Rights and obligations, yes. Yeah, my disguise didn't fool you all. Yeah, rights and obligations. So the reason that we talk about this, we say this is an assertion related just to account balances, is that this only relates to information in the financial statements. But it is pretty much as it says. Do we have the right to recognize assets? So if we have an asset on the balance sheet, is it ours to recognize? This often comes up when we have assets that may have been traded or sold off. If you sell an asset, you don't get to continue holding that asset on the balance sheet. That's just a problem, okay? That's an issue. We're going to actually be talking about WorldCom and forensics here in a few weeks, and that was something they were doing. It's kind of something they were doing. They were recognizing assets that weren't really assets. So, so that's a concern that we have about. And same true for liabilities. If it's not something that we hold as a liability, we no longer have the obligation to recognize that. So it's about whether or not recognition should occur. All right, then we have some assertions that are going to be specific to certain standard areas. We have this thing called presentation. Now, you may want to make a note on this presentation that you might want to add and disclosure, presentation and disclosure. I call it presentation, but the PCAOB refers to it as presentation and disclosure. It's the same thing. It's whether information is properly presented in the financial statements. Now, even though this sounds like account balances only because it's financial statement related, this can relate to both categories of assertions, transactions and events, and account balances, because it can relate to whether transactions are properly presented and disclosed. But oftentimes, this is just basically the form of the information that this takes in the financial statements. Now, you will notice I put PCAOB up here. This assertion is related to the PCAOB standards only. In fact, if we look at the PCAOB standards, we are going to see 5 assertions listed. It's these first 4 and this 5th one right here. Okay. Now, I do want to throw a caveat out there because I had to explain this to my students, my 417 students. The reason that we kind of congregate all these together is that you're going to be responsible for knowing all of these assertions for the CPA exam, but we study them all. It's the delineation of whether it's PCAOB or ASB is not a big deal, not a big issue, but I do provide that clarification for you. So that's not something I think you need to anchor on. This is just more of an explanation foundation for it. As far as ASB assertions, we've got classification and cutoff. So classification is pretty straightforward. Did we properly classify an account or a transaction in an account or an item into an account? This comes up very, very frequently when we talk about asset recognition or liability recognition, simply because there may be an incentive for our client to misclassify particular transactions. Think about those debt covenants that we talked about back in 417. Remember, debt covenants say that you have to maintain a certain financial ratio, like current ratio of a certain amount. Well, if my current ratio is too low to meet that debt covenant, could I just reclassify some long-term assets as current assets? I shouldn't do that, but could I do that? Yeah, okay. A good auditor will say, no, we know what you're up to. Not to do that. Same thing for current liabilities. We want to shift current liabilities to long-term liabilities. That's an example of classification violations. And then cutoff is another recording assertion, okay, but it recognizes whether an item was recorded in the proper period. Okay. So it's important to note cutoff is just related to transactions and events, and whether it recognizes whether a particular transaction event was recorded in the proper period. Account balances are less, there's less scrutiny with respect to whether they're recorded in the proper period, because those are just in the period that they're recorded or that they're recognized. I think I have this on here. Yeah, this one's the assertion that's not really an assertion. I made a lot of fun of this in 417. I'm not going to make much fun of it here because we're not going to acknowledge it as much, but that's authorization. The only reason I bring this up is if you still have your auditing textbook, the auditing textbook still, after 20 years, 20 plus years, still recognizes this as an assertion. It is not an assertion according to the PCOB. It's not an assertion according to the ASB. But the book says it is. Okay. They even actually acknowledge it in one of their frames. They say, this is not really an assertion according to the standards, but we're going to leave it in here just because we're too lazy to get rid of it. They don't say that, but that's basically what it translates to. Yes.
What does the MGP stand
It's Messier, Glover, and Prados. That's the authors of the textbook that we used back in 417. Yeah. So yeah, good question. I probably should have specified that. Not really an assertion. So we're not going to categorize that as an assertion. I just threw it back in there because you may remember we talked about that back in 417. Yeah, so the management assertions, again, we are going to be referring back to those. We're going to look at those in context of very specific examples and violations of those. Let's go ahead and let's talk really quickly about categories of assertions, okay, because this will come up. So what are the transactions and events assertions? Now, the very easiest way to think about the transactions and events assertions is that it's all the assertions except for rights and obligations. So I'm going to assume in this course that you know all of the assertions, all 7 assertions. If you really want to impress me and know the 8th assertion, that's fine, but we don't need to remember authorization. Okay, you're never going to forget it because I make so much fun of it, but you don't need to know that one. But all 7 assertions except for rights and obligations, so 6 assertions. So list those out. Here we go. I think I put authorization on there just to be thorough. So why is this relevant? Well, when we talk about a transaction or event, we're talking about a day-to-day operation of the organization. So if we're talking about our concerns with this as auditors, we're concerned with what's happening on a transactional detail, what's happening on a day-to-day basis. Now, how does this relate to our testing? Well, remember we talked about the phases of an audit back on Wednesday. We talked about the planning phase, risk assessment, test of controls, substantive procedures, audit conclusion, and report issuance. There's a lot of steps that we could actually walk through an audit, but only 2 of those phases are phases where we're going to gain assurance with respect to assertions, okay? Those are going to be our test of controls and our substantive procedures. Now, I'm not saying the other phases are not important, but when we talk about audit testing specifically and testing the assertions, those are going to be consolidated within those 2 phases. The reason this is important is that testing of transactions and events can take place in both phases. It can take place both under test of controls and substantive procedures. All right. Now it's important to note here, and this is going to give a spoiler to the next slide. Transactions and events is transactions events is exclusive to test of controls. I think I said that wrong. Test of controls is exclusive to transactions and events, which makes sense because what are controls in place for? Controls are in place to make sure that there's a proper flow of transactions within the organization. A transaction flows through a control and to make sure that there's a check for that transaction that moves on to the next step. Okay. So that's intuitively correct about why we would think about that as transactions and events. We can test substantive procedures, transactions, and events, but that's less common because we're assuming most of our assurance for transactions and events will get tested here, but it's still a possibility. With respect to that, what are the account balance assertions? Okay, it's going to be all 8/7 assertions, all 8 except for cutoff. And technically speaking, authorization is left out here, but authorization should be left out at this point anyway. Okay, so it's going to be everything except for so 6 of these. So we don't have cutoff up here, and we don't have authorization up here. Authorization hasn't just left out because it's a non-real assertion, but it also doesn't have anything to do with account balances. Okay. Now, I do want to put a clarification point out here because this is something we talked about in 417 that is a reminder. You may say, this is confusing, Dr. Barnes, simply because I don't understand how completeness can relate to both transactions and events and account balances. And the answer is the concept is still the same, but our focus is going to be different here. Or when we talk about it, we talk about completeness of the transactions and events, like we're saying, did a particular transaction properly get recorded? I shouldn't say properly recorded. Did it get recorded in the system? Okay. And then, so if I talk about that, I'm concerned about individual day-to-day operations. Now, I talk about completeness at the account balance level. Said, did an account balance get recorded? Did an account get recorded in the financial statements? The aggregation of all the information. So if the answer is no, that's a completeness violation there. It's a little bit of subtle distinction, but they mean basically the same thing. It just depends on what is our focus. Is it on the transaction, the individual transactions, on the account itself? As I alluded to already, the only phase of the audit testing that for account balances is substantive procedures. Now, why is this important? Because we know that certain types of testing are going to be focused to either transactions or account balances. Okay. And if we have a test type that can only test account balances, we cannot use that as a test of controls. I want to see if you all remember, because I rail about this, and you may say, well, we took different sections of your course, Dr. Barnes. Are you sure you railed about it in my section? I rail about this in every section of 417. I said, there is one type of audit evidence that we can gather that cannot be used as a test of control. Does anybody remember what that test was? Well, we'll get to that, okay? You will never forget it. I said you would never forget it in 417, but apparently everybody's forgotten it. It's been a while. Everybody slept since then, okay? Says, well, you remember, Dr. Barnes, only because you teach it every semester. I said, yes, that's the key. Teach it 10 years and you'll never forget this, okay? So yeah, that's going to be important to note is the distinction between whether or not we're going to be testing transaction events and account balances. Before we get to that, though, let's talk about something that I let slide a little bit back in 417. We talked about it very early on, and then I don't go into much detail about it afterwards. So concepts of audit evidence that are important to understanding the conduct of the audit. And there was 3 of these that we need to understand. They're not particularly difficult, but it's important to make sure we reflect upon these because these anchor our testing moving forward. So first of all, the first concept is the nature of audit evidence. What is the nature of audit evidence we're gathered? Now, this is something that you may not recall because you may not recall as distinctly because you've had 417, and so you're familiar with categories of audit evidence. But this is something that when I talked to my 417 students on Wednesday for our first introductory lecture, I said, would you think we would gather audit evidence? What form would that take? And all of them were like, well, I would assume accounting records. And I say, yes, accounting records represents a form of audit evidence. It represents exactly one type of form of audit evidence, okay? There's a lot of different forms of audit evidence, though. And the nature of audit evidence says that accounting records can be one form, or there could be everything else, accounting records versus other types of information, all right? And the joke that I used back in 417, and I know because I use this every single semester, is that it's like that old Mark Twain joke. There's only 2 times in life a man shouldn't gamble. It's when they don't have the money and when they do have the money, okay? So yeah, that's kind of the idea here is that accounting records and everything that's not accounting records, those are the types of evidence. So basically anything can be a type of evidence. The second category represents the sufficiency and appropriateness of audit evidence. Now, what do those concepts mean? Sufficiency and appropriate audits, they mean quantity and quality, okay? And I'm not going to try to disguise it, okay? Sufficiency is quantity and appropriateness is quality. If you think about it, it makes sense. So we need to gather enough audit evidence to be able to make have a proper assurance, and our audit evidence needs to be appropriate to whatever the assertions that we're trying to test in a particular area. So it's important to note that both the amount and the quality, the nature of the, I shouldn't say nature, but the how good the evidence is going to be really, really critical. The final concept is going to be this idea of evaluation audit evidence. And we spent a little bit of time talking about this within one area. Does everybody remember the professional judgment framework where we talked about the different biases that people are subject to? And I say, we are all subject to certain biases, whether we want to admit it or not. Okay. Yeah, we talked about that. The evaluation of evidence basically says, is evidence reliable and free from bias? And this is something that we tend to be very, very sensitive to as auditors. Simply because of the nature of auditing, we're under certain time constraints, particularly time constraints and budget constraints. So we don't want to spend a lot of time testing when we don't have to. But there might be situations where it requires additional testing. You may actually come up in a situation where you say, all right, the transactions have changed pretty substantially. The nature of the transactions have changed pretty substantially from past year. So doing the same thing that they did last year may not be appropriate. There's an old joke. So if you try to remember what the procedures in an audit are, there's an acronym. It's SALY, S-A-L-Y, WIMSON, W-I-M-S-O-N. Same as last year, whether it makes sense or not. Okay. So yeah, same as last year can give you a good template, but it's not always appropriate. And it's a violation of that availability tendency or availability bias. when we run into that. If we have to be honest to say, does it make sense to use previous year's analysis if things have changed substantially from the previous year? All right, phases of audit testing. We've already talked a little bit about this. So again, we start out with planning phase, which we talked a little bit about on Wednesday, okay? Then a subset of the planning phase is going to be risk assessment. Now, we've already gone through risk assessment, but that's the reason I talk about this. This is the first time where I think we can actually gain assurance. We don't specifically focus on assertions testing and risk assessment, but we can gain some assurance in this area. Then we've got our test of controls. Okay, everybody knows Dr. Barnes loves controls. Okay, we know that Dr. Barnes loves to focus on controls, and we're going to talk more about controls here in a little bit. But testing of controls is really important. And then we have our substantive procedures, and substantive procedures have two subphases: substantive analytical procedures and substantive test of details. Also, I want to throw in here, just because I'm not going to probably mention it specifically, we are going to actually look at some examples of it in the course, but I'm not going to mention it through the review lecture other than this. There's a term for it that examines both test of controls and substantive test of balances, substantive test details. These are called dual purpose tests. And the reason that I mentioned this is we're actually going to look at a series of dual purpose tests later on in the semester. It's a little bit misleading to say that these are truly doing the same thing. Usually what this means is that we can cover multiple assertions related to transactions and events and substantive procedures. They do involve slightly different types of tests, simply because if a test covers a test of controls, it's not going to look the same as substantive procedures. But we can perform the test at the same time and get assurance in both areas. So dual purpose tests are not necessarily the same exact test that you choose for multiple procedures, but doing multiple testing procedures at the same time. So it's a little bit of a misnomer in the slide. Okay, here's our audit procedures and reliability. And by the way, if you don't remember these particularly well, you remember there was a spreadsheet that we put back in 417 where I listed out the types of tests. I listed out the assertions and their level of reliability. That spreadsheet is still available to you. It might be a good resource for you to look at. You're going to become acclimated to this very, very quickly, simply because our difficulty is going to ramp up much more quickly in this course than it did back in 417. That being said, it might be something that you want to refer to if you're having some struggles, okay? So I'm not going to match the assertions to audit evidence for the most part. We're going to talk about them at a very basic level. Some of these are going to be very specific to certain assertions. But let's go ahead and go through these and make sure we understand what each of these represents. By the way, you can ignore number 9. I keep meaning to leave this, to remove this. This is an old test that is no longer relevant. It's no longer tested on the CPA exam, or at least not very heavily tested on the CPA exam. And I keep forgetting to remove this from my graduate slides. So this is going on like 5 years now that I've forgotten to remove this. So my bad. All right. So we're just going to talk about the first 8. So first one's inspection of records and documents. And these are our accounting records that we just talked about earlier. These are kind of baseline. What is the great thing about inspection of records and documents? Well, one thing is that they are very versatile. They can be used during multiple phases of the audit. Remember, we talked about the phases of the audit last time, and we had 3 types of tests that we used during multiple phases. Inspection of records and documents is one of those. And they provide a reasonable level of reliability because they are accounting records, okay? That being said, they're not our highest reliability test, and we'll talk about why here in just a second. We have specific types of testing for inspection records and documents that are relevant to directional testing. So we have vouching and we have tracing, okay? Now, all these are inspections of records and documents that move in a specific direction. Vouching moves for existence occurrence, so it moves top to bottom, and tracing moves bottom to top. Does anybody remember how we recognize those directions?
Put a hat on the T.
Yeah, put a hat on the T and put an arrow pointing down on the V. Okay, that's it. If you remember, vouching is associated with existence, occurrence, and tracing is associated with completeness. The directions are very easy because you remember the arrow points up with the T, the arrow points down with the V. Again, I can't take credit for that. It's a Becker thing, but it is a very clever way to think about that, and it will save a lot of turmoil if you remember that. It kind of bundles everything up into one nice little package. Then we have inspection of tangible assets. Now, when we talk about tangible assets to this regard, this can be any tangible asset, but by and large, this is used very heavily for large assets, okay? Land, property, plant, equipment, vehicles, things along those lines, okay? I guess land and vehicles are both property, plant, equipment, but you see where I was going with that, okay? Yeah. So what is an advantage of inspection of tangible assets? You will notice that it says high reliability, okay? Now, why is this higher reliability than this? Does anybody remember the reason for that? If I'm inspecting the tangible assets, who's performing the test? Me, the auditor, okay? If I'm gathering inspection, or if I'm gathering documents, who prepared those documents?
Not you.
Not me, the client, okay? We actually have a mnemonic for this. This is again another Becker clue, which again, part of me, I really like this mnemonic until I get to the very end. It's very silly. Okay. The way they think about the spectrum of reliability is the vowels A, E, I, O, U. All right. So A is auditor generated evidence. That's the highest level of reliability. E is external evidence. That would be an example of bank statements or like external client information. Then I is internally generated evidence. O is called oral evidence, but I think it's easier just to think about observation and inquiry, okay, because that also starts with an O. And then U is kind of the reason that I don't like this one is because it says you know it. That's what they say in Becker, which is just so cheesy, but you remember it, okay? Personally, I've written a few times UGH as just because I'm not going to say you know it. But I said it now, so they got me. Yeah, so inspection of tangible assets, very high reliability because we as the auditor perform that testing, okay? The trade-off here is inspection of tangible assets only test one assertion. Anybody want to guess which assertion it tests? We got 8 to choose from, so you got like a 1 in 12 chance, 12% chance, yeah, 1 in 8 chance, 12%. I'll give you a hint. It's one of the three, big three. It's existence, occurrence. Yes, existence, occurrence, which makes sense because if we're concerned, does this building exist? If I go out and say, oh, there it is, I guess it exists. Yeah, makes a little bit more sense. All right, then we have observation and inquiry, which are just as they sound. Observation is looking at somebody performing their task, observing them performing the task. Inquiry is asking people about the responsibilities they do. Now, observation and inquiry, again, very versatile, much like inspection or records of documents. We can use them during multiple phases of the audit. The trade-off is they are low reliability. Now, why are they low reliability? The first answer, an obvious one, is because we know in our mnemonic, A, E, I, O, U, they're near the bottom, okay? They're at the O, okay? But intuitively, why would you say that's low reliability? If you're asking somebody a question, is it possible they could lie to you about the answer? Yeah, it is possible. I know. We don't want to believe it, but it's possible. If you're observing somebody doing their task and they know that they don't want you to see when they do bad things, is it possible they may not do anything bad while you're watching them? Yeah. So these are one of those low reliability tests that usually are a starting point. They give a foundation, but they generally are not an endpoint. We usually have to supplement those with corroborating evidence, which basically means another higher reliability type of evidence. That is the trade-off here. They can be good for getting a general understanding, but generally, honestly speaking, we cannot stop there, at least in most situations. There are situations where observational will suffice. That is points where we need very minimal amounts of assurance. Okay, if we don't need a lot of assurance in an area, then maybe just these will suffice. All right, confirmation. Confirmation, if you remember that's a third-party request. A third-party request. That is external parties. We want to get information about this. This is used for testing a lot of our assets and liability balances, like accounts receivable, accounts payable, cash. We can send out to the third parties and say, hey, here's what we have to report as a balance. Is this correct? And they can say, yes, no, this is the correct balance. Confirmation is medium reliability because it is an external party. Also, it's important to note, confirmations almost exclusively test account balances, at least to a degree. They can test disclosures in the financial statements as well, but they never test transactions and events. Why is that important? Remember earlier I said there was a type of evidence that can never be used as a test of internal control? What type of evidence do you think can never be used as a test of internal control? Confirmations, okay? If you remember, I don't know, you don't have the exams in front of you, but I asked an exam question, every single one of the 3 exams, I asked a question of this nature about whether confirmations can be used as a test of control. The answer is no, never, at least not in this course. You may be able to find in the real world some exception where somebody used as a confirmation of test of control. But as far as this course goes, when we're in these hallowed halls, never a test of controls, all right? Recalculation is just as it sounds. This is a mathematical operation. Now, again, much like in detection of tangible assets, we're doing the work as auditors, so it's high reliability, okay? The trade-off being is that it only tests one assertion. Which one of the 8 assertions do you think it tests? VAA, very good. No problem gun there, all right? Reperformance is an interesting one. Reperformance is a very high assertion because we as auditors are reperforming the work of the client. And it can test multiple assertions, which is kind of nice. I believe there's a limited number of assertions, but it's a multiple assertions like completeness, existence, occurrence, and I want to say a few others as well. So it's actually testing multiple assertions, which is great. Reperformance is interesting in that it can be used during multiple phases in the audit, but it's almost exclusively used as a test of controls. And we're going to look at that here in a little bit when we start talking about test of controls. we're actually going to have an exercise that's going to be running through a series of test of controls, and we're going to see when can reperformance be used. By the way, I do want to mention this now because we've talked about all the test of controls: introduction record documents, observation, inquiry, and reperformance. There was a fifth one that's not on this list that's basically a combination of all these procedures. Does anyone remember that term?
Walkthrough.
Walkthrough, yeah, very good. Walkthroughs, okay. We're actually going to talk about those as well. The reason this is not on the list is because it's a combination of multiple procedures, but yeah, it's an important one to remember as well. Then we have analytical procedures, which is our last one. Analytical procedures, I think we're maybe doing a task of analytical procedures again in this course, but this is basically looking at trends or developing expectations based on financial presented data of the client. Now, analytical procedures are interesting in the fact that they can give us a lot of assurance for very little work. Not tons of assurance. There are still medium reliability because we are relying on client-generated evidence. But it would, if we can get enough assurance in a certain area, we could completely bypass substantive testing if we think that it's possible to get enough assurance through an analytical procedure. That being said, analytical procedures usually only test two assertions. VAA is the obvious one because it's a mathematical operation, but they can also do ancillary tests to completeness as well. All right. So what is the goal of audit testing? What is the goal of audit testing? It's like to make you happy, Dr. Barnes. Well, thank you. Okay, that's obviously one goal in the course. But when you go out in the real world and you're trying to do the testing, what's the objective you're trying to gain? And the goal is, remember, our goal as auditors is to make sure the financial statements are free from material misstatement. And at some point, we need to gain reasonable assurance that that statement is correct. So assurance is an aggregation task. Okay, we gain like 1 unit of assurance. We gain 5 units of assurance. At what point do we have enough assurance? And obviously, it's hard to quantify because, first of all, assurance is not necessarily quantifiable by nature. Secondly, we don't really have an arbitrary amount that we say this is our assurance level. But to some degree, we're trying to aggregate enough assurance that we can be confident that we are reasonably assured the financial statements are free from material misstatement. Now, the way that we started out talking about this in 417 is we said, let's make sure we have a bucket for each assertion, okay? And we're going to pour different procedures into the bucket. And if we have a lot of assurance in one procedure, it means that we need less assurance in another procedure, okay? Which is great because if we can rely on test of controls very heavily, it means that our work in substantive analytical or substantive procedures can be reduced, okay? My favorite analogy on this is I took this and I kind of twisted it. And this is what I'm very proud of. This is Chipotle and a burrito analogy, okay? So remember Chipotle burrito, they add rice to the burrito so they don't have to add good stuff there. What happens when you say no rice on my burrito? Okay, they may kick you out. I mean, to be honest, is to say no rice on a burrito ever. Like I'm traditionally concerned that most burritos don't have rice, at least not the good ones. But why did they put rice on the burrito? Because rice is cheap. Okay, you can put a lot of rice on the burrito for very little cheap, and you don't have to put the good stuff on there. So that is kind of the same thing, is that if they gain assurance that you put in the rice on there, they don't have to gain assurance by putting the guac and the chicken and the salsa and the cheese and the good stuff on there, okay? If you ask no rice, they have to give you more of the good stuff. That's a little bit like us having to do additional substantive procedures to make up the fact that we didn't get assurance through test of controls. Ultimately, it's just a quantification objective. We're trying to make sure we have enough assurance in the process. Real quick, let's talk about documentation, okay? So remember audit documentation, that was our working papers, our word papers we talked about. There's a lot of different forms for that. I don't think you need to worry too much about the types of documentation. It's more about the nature of documentation. It was very interesting. We had a KPMG audit partner speak to our 417 class last semester. And one thing he talked about is understanding of documentation is more important than before, not because you as auditors are going to be doing documentation or preparing documentation. There's going to be outsourced mechanisms that will be doing the documentation preparation now. You're going to be responsible for reviewing and scrutinizing documentation. So one of the hopeful tasks here is we're going to be looking at documentation moving forward, not just preparing it, but also to scrutinize it and make sure that we understand whether something is correct or not. So that's something to understand as well as moving forward. Okay. Important thing to note, this is something that's on the CPA exam. So one of the things that I kind of talk about here, three characteristics of documentation that must always be present. Now, the form of documentation can change depending on what the documentation has, but there always needs to be these three things present. First of all, the heading, okay? The heading consists of multiple elements. Usually it's going to be an explanation of who the client is, what is the period under review, what is the nature of the working paper. Like if we're doing an accounts receivable testing, it needs to be saying that the heading that's accounts receivable testing. Also, there needs to be information about who performed the testing and the date they performed the testing, as well as who reviewed the documentation and when they reviewed the documentation, all right? The next item is going to be indexing and cross-referencing. Does everybody remember the idea of index? It's like an index in a book. When you had page numbers, you can say, this is on page 15. Same old's true for working papers. We say, this is on working paper I-17. So you flip through section I, number 17, there it is. Then this concept of cross-referencing was really important. Cross-referencing basically says that any information that's in a working paper should have some support in other parts of the working paper. So I start with my trial balance and I'm going to test accounts receivable. And accounts receivable are tested in section E12. So I put a notation on accounts receivable, E12. Then I still go to section E12, and when I'm looking at my balance for accounts receivable, I've got to reference back to my trial balance where that account balance comes from. So the trial balance is in A2, okay? So I put A2. That's a cross-reference when they refer back to one another. So you can actually, it's kind of a circular loop in Excel, but it's for our purposes, it's basically saying where the information goes to and where it comes from. And then finally, we have tick marks. Tick marks are just shorthand notation, so we don't have to repeat ourselves multiple times in the working paper. We'll be looking at multiple examples of that as well. So how long does the Sarbanes-Oxley Act and the PCAOB require firms to retain audit documentation? The answer is 7 years from the end of the audit, and then unless a longer period of time is required by law. Let's go ahead and make a note of this because this probably will come up in your studies, okay? But this rule is not the same for the Audit Standards Board, okay? So this rule is only 5 years for non-issue audits, all right? So not 5 years for non-issue audits, which makes sense because the PCAOB tends to be a bigger, more prominent company. So 7 years, a longer period of time, makes a lot more sense. For non-issue audits, archiving and retention only needs to take place over a 5-year period. Okay. Internal control time. So I've got 13 minutes to talk about this. Not enough time, but fortunately, we've got an entire semester to go through this. So internal controls. Why are internal controls important? Well, they contribute to the reliability, timeliness, and transparency of external financial reporting. They prevent or they detect and correct material misstatements in the financial statements. And internal controls over financial reporting, ICOFR testing, are required for most publicly traded companies. Now, a couple of really important elements are in this slides, even though this is an aggregation of a lot of information. Let's talk about the first and most important one. We talked about the objectives of internal controls back in both 367 and 417. And the objectives relates to financial reporting, operations, and compliance. Remember, the most important of those in an audit was financial reporting. Why? Because an audit relates to the presentation and preparation of financial statements, okay? So financial reporting, really, really important. We actually have a specific type of internal controls testing that's required for financial reporting. It's called internal controls over financial reporting testing. ICOFR, for public companies, this is required. Again, we'll look at more examples over the course of the semester. Also, generally speaking, controls do one of two things. They either prevent problems from occurring, or if a problem occurs, it detects the problem and then subsequently corrects the problem. And the reason I mention this is these two are usually paired, okay? Not always. There are situations where there's not a pairing for that, but for the most part, they're usually paired, which makes sense. If you find a problem, you probably want to fix the problem. It doesn't make a lot of sense. I found a problem. That was close. Yeah. It's like, okay, do you want to fix the problem so that it's not in the financial? Oh, yeah, it's probably a good idea. Yeah. So detection and correction. So what is the name of the framework that's used, the internal control framework that's used by most companies in the United States? Actually, most companies worldwide. Does anybody remember that? You don't have to give me the name of the framework, just the 4 letters that it represents. COSO, Committee on Sponsoring Organizations, Internal Control Integrated Framework, okay? All right, something I told you never to forget, and I want to make sure that you don't forget this, okay? What are the 5 components of the COSO Internal Control for Integrated Framework? And by the way, I've asked you this question in multiple courses before, okay? 3 I can think of, okay? 3 that I can think of. Actually, Alex and Isaac, you've got excuse. There's only 2 courses for you guys, okay? But COSO Internal Control Integrated Framework. What's at the top, okay? Code at the top, what do we call that? Control environment, okay. Then we talk about making sure that we know what the need for controls are. What does that emanate from? It needs risk assessment, yes, okay. Once we've identified the risk, we create the controls. What do we call that step? Control activities, very good. And then once we actually have our control activities in place, we need to make sure people know what they're supposed to do with respect to controls. What's that called? Got to communicate that to them, so probably give them good information and communication. Yeah, information and communication. And then control risks will change over time. When risks change, we need to make sure we update that. What's that process called?
Monitoring.
Monitoring, very good, okay. Yeah. Won't that be great at some point when you actually leave this university and say, I don't have to wear that COSO anymore? I would just hope that a partner comes up to you. What are the 5 components of internal control? And you'd be like, curses. Yeah. Actually, what's going to happen is you're going to come back and you're going to visit and you're going to be all successful. You're going to be donating. I'm going to be retired, but I'm going to come back and visit and say, hey, how's it going? What are the 5 components of internal control? And you're going to be like, correctness, evaluation. Yeah, okay. With respect to internal controls, the auditor can follow 2 types of strategies. Now, for the most part, with PCAOB testing, we're going to follow the first one of these, okay? Or sorry, the second one of these. But there may be some situations, particularly if we're talking about non-issuer companies, where they may not have strong internal control frameworks, so we may say it's inefficient for us to test internal controls, or at least it's inefficient for us to test internal controls in a certain area. If we're not going to rely on internal controls, what type of strategy are we going to adopt? Now, I'll give you a hint. Usually means that we're going to gain most of our assurance from substantive procedures. So it's probably a substantive strategy. This basically means that we're not going to test controls in a given area or in a given audit, and we're going to gain our assurance from substantive procedures. The other one means that we are going to rely on controls to some degree, so we have to test controls to make sure that they are operating as intended. If we are going to rely on controls, we're going to follow a reliance strategy. Now, I already mentioned which one of these do the public company audits most units follow. I said it was the second one, reliance strategy. Why is that the case? Because remember, internal controls testing is required for most public company audits, at least in the areas where controls are important. Is it possible that you could do a public company audit and say, this section of the audit, I'm going to do a substantive strategy? Absolutely, okay? Especially if it's an area where there's not heavy internal controls over financial reporting, or it's not efficient to test controls in that area. So internal control systems should be designed and operated to provide reasonable assurance that these objectives are being achieved. So that's kind of an interesting blurb, okay? So basically what we're trying to make sure is that our client creates internal controls and make sure the financial statements are free from misstatement. The transactions flow through the system and they are properly checked. That's basically all there is to it. Now, controls are great, okay? You guys know how I feel about internal controls. Internal controls are quite possibly the best thing ever. That's a direct quote from me a long time ago. But there's possible limitations of internal controls, inherent limitations. So one is going to be management override of internal control. So if management override is a limitation, does that mean we should just get rid of management override? What was my example back in 417? Remember, you go to Taco Bell and you buy something. Yeah, Taco Bell. You buy something. You say, "Here's a $20 bill." They take the $20 bill and put it in the register. And you say, "Where's my change?" Say, "Oh, sorry about that. Have a nice day." It's like, "No, I want my change. Open the register." So I can't open a register. It has to be a transaction for me to open the register. And well, the transaction's done. You're going to say, "Get the manager up here with their keys. I want my change." So a management opening the register, that's a management override. Okay. Can we agree that that's a necessity? Or do you all just want to make donations to Taco Bell for the rest of your life? I'm going to make donations to Taco Bell. Personal errors and mistakes. I'm not going to go too much into this to say that mistakes happen. We can't design controls to address every possible error, every possible mistake that we can address. There have been some very, very interesting scenarios, some big issues that have happened that have emanated just from mistakes and errors, okay? The McMillian scandal is one that I'm really fond of talking about. If you've never watched that HBO documentary, it's fascinating. I know you all don't have a lot of free time, but when you do have free time, like 40 years from now, remember that one, okay? All right, then we have collusion, okay? Collusion. So one of my favorite controls has 3 points. CAR, what does that stand for? Custody, authorization, and recording, okay? What do we call that? Segregation of duties? Yeah, segregation of duties. Is it possible to bypass segregation of duties through collusion? Yes, especially if people work together. The easy way to think about it is like we're on a quiz, okay? And Troy and Cole decide that they're going to look at some notes while they're taking their quiz, but they see me scrutinizing it and watching their screens very, very closely because I'm up to them. I'm on to them, okay? So Troy says, "Dr. Barnes, I have a question. I'm not sure what you mean by this." And so he diverts my attention, and then Cole pulls up his notes and basically starts looking at it. So that's colluding, okay? It's colluding to bypass the control that I set up while watching it, okay? And obviously, I want to only mention Troy and Cole because I trust them completely. So I don't trust any of the rest of you. So yeah, that's the goal. All right. So reporting on internal controls of financial reporting, there are 3 levels of severity of related deficient controls. The least severe is given it's a control deficiency. Okay. So what is this? What is it we report to on this one? It's a report to management. Okay. So basically, a control deficiency is just anything that's a lapse in internal control. And if it's doesn't really have to have a large magnitude. It's just any kind of problem. Usually, when we talk about a low magnitude issue, we're just going to report this to management, and all there is to it. That's all there is to it. Weakness has a potential result in a material misstatement. This is a type of control deficiency that's a lot more severe, okay, a lot more severe. But it's not likely to result in a material misstatement unless it's left unchecked. We call this a significant deficiency, okay? A significant deficiency, we have to report this to management and also to another party. Which one? The audit committee. We have to report that to the audit committee, okay? Then if we talk about a weakness in internal control that's likely to result in material misstatement, so it's likely to result in material misstatement, we call that a material weakness. Material weaknesses, those get reported externally. So management, audit committee, and anybody who uses the financial statement is going to know about this, okay? This is a big deal. We want to know. So we report that to everyone. In judging this area, significance of control deficiency, auditor must consider two dimensions of control deficiency. We've got likelihood and magnitude. So first of all, we must establish that it's likely for an error to occur. If it's not likely to occur, if it's a remote possibility, it's not going to be any type of deficiency whatsoever. But if we assume that it's at least reasonably possible, that is where we assess the magnitude based on the characteristics that we talked about before. Minor issue, report to management as control deficiency. Major issue, or material but not significant, significant deficiency, report to audit committee management. Material issue, material weakness, we report externally to everyone. When attaining an understanding of a client and environment's controls and establishing a preliminary assessed control, a preliminary level of control risk, I just said it, we call this an assessed control risk. This is a little bit different from something that we talked about at test controls. When we conclude our effectiveness, this is called achieved control risk. Why did I bother including this in here, by the way? This is an important one to note. As we're working through some of our tasks in this course, one thing we're going to note is there is a conflation of information. Assessed control risk should be preliminary. Achieved control risk should be subsequent, okay? That is the way it should work. That is not the way it's always presented. So you do need to be very, very conscientious about understanding when we talk about control risk, is this an initial assessment before controls are tested? Or is this a subsequent assessment after control assessment is concluded and we have tried to make our determination of what actual control risk is? Now, the CPA exam, Becker, all those, they will use this terminology correctly sometimes, but sometimes they will use it incorrectly. Sometimes they'll talk about assessment of control risk after controls testing is taking place. Do not rely on the terminology itself. Make sure you understand at what point in testing of controls we are. And that's going to be really, really critical understanding what is going to be, how we use control risk in that context. Real quick to note, last thing to wrap up, we want to make sure that we understand that audit procedures can be conducted at an interim date or year end, okay? So we can actually conduct those before everything is concluded or conclude those at the end. We talked a little bit about the idea of timing before. So what's the advantage of interim testing, okay? Why might we perform interim testing of financial statements? So are you going to be more busy at interim or at year end? Year end. So if we kind of distribute your work out over a longer period, is it going to be a little bit easier to complete that work? Yes. Okay. So usually the auditor will have to complete some of the testing prior to year end. What's one disadvantage? If you're doing testing in interim, do you have all the information you need to test? No, the financial period is not ended yet. So you don't necessarily have all the information you need. Okay. Which means it's usually less effective than year end testing. So. And by the way, you can kind of see how old some of my testing information is because you can kind of see the dates that I'm using here. This is an old clip from the same book that we've been using for a while. 10 years old, Dr. Barnes. This is 10 years ago. I was in middle school, Dr. Barnes. Actually, 10 years ago. How old were you? You guys weren't even middle school. You were still in elementary school? No, middle school. Okay. I'm not giving you guys credit for your age. My apologies. Okay. My apologies. So yeah, when we talk about interim testing, generally speaking, we're going to do our planning early on. We're going to conduct interim test of controls. And interim testing of controls is pretty consistently occurring. The reason why is we expect most controls to operate the same way throughout the period. So interim testing controls should stay pretty consistent from period or from at all points during the period, which means that we can test those at interim and get a lot of assurance. Then we can conduct substantive tests at interim, and a lot of these have to take place at year end. All right, that's all. Have a great weekend, a great extended weekend. I'll see you all on Wednesday for this class, Tuesday for the other class.
It's nice, but